Imagine you've spent your entire life carefully crafting an investment portfolio, trusting bonds as your fortress against market volatility. But as the years pass, you begin to hear whispers. Is that fortress starting to crumble? Are the traditional ways of investing truly as safe as they once were? Are bonds still the reliable haven they've always been, or are they walking a dangerous path in 2026? Respected viewers, the idea of safety in investing is one of the most sacred beliefs we hold. When we think about bonds, we think about security. They've been the gold standard of low-risk investments for decades. Bonds are seen as the bedrock of a conservative portfolio, fixed income, steady returns, and relatively low volatility. But as we march toward 2026, a question needs to be asked, are bonds really safe anymore? You see, in the past, bonds have been the asset of choice for investors seeking stability. Treasury bonds, municipal bonds, corporate bonds, they were always there to provide a steady stream of income. Whether in times of prosperity or economic downturn, bonds offered safety. But this was a different era. Interest rates were low, inflation was manageable, and economic conditions were relatively stable. But is that still the case today? The truth is that the financial landscape is changing rapidly. We're facing an environment of rising interest rates, increasing inflationary pressures, and mounting debt levels across the globe. And all of this is happening at a time when central banks are tightening their monetary policies. This poses a very real threat to the bond market and, more importantly, to the investors who are depending on it for safety. Inflation is a stealthy enemy. It creeps in slowly, often unnoticed, and yet it can devastate the value of fixed income investments like bonds. When inflation rises, the purchasing power of your returns diminishes. If you're holding bonds with fixed interest rates, those payments become less valuable as inflation erodes the value of money. This is particularly concerning for bonds with long durations, as the longer the term, the more exposure there is to inflation risk. Look at the situation today. The inflationary pressures we've seen over the past few years are not just a passing phase. While some people believe that inflation will subside as economies stabilize, there are growing concerns that inflation might stay elevated for longer than expected. For investors holding traditional bonds, this could mean a serious erosion of their investment's value. A bond paying 3% annually is much less attractive when inflation is running at 5% or more. Let's not forget the history of inflation's impact on the bond market. During times of high inflation, real returns on bonds can turn negative. In fact, the 1970s were a stark reminder of just how devastating inflation can be to bondholders. So, with inflation forecasts uncertain and interest rates rising, it's imperative to ask, can you still count on bonds to provide that safe, reliable income stream in 2026? As we approach 2026, another factor weighs heavily on the bond market: rising interest rates. Central banks, particularly the Federal Reserve, have been increasing interest rates to combat inflation. And while higher rates are necessary to cool down an overheated economy, they have a direct and often painful impact on bond prices. Here's the key: when interest rates rise, the price of existing bonds falls. This is the inverse relationship that many bond investors overlook. If you're holding a long-term bond that yields 2% while new bonds are being issued with yields of 4% or 5%, your bond becomes less attractive to potential buyers. Why would anyone want to buy your bond for 2% when they could get 4% or 5% elsewhere? Now imagine the scenario playing out over several years. As the Federal Reserve continues to hike rates to combat inflation, the bond market could face significant losses. For investors who rely on bonds as a core part of their portfolio, this presents a very real risk. So, how should investors navigate this changing landscape? Are bonds still worth holding in 2026? The answer, as with most investment questions, is not black and white. In times of rising inflation and higher interest rates, the traditional bond market faces significant headwinds. But that doesn't mean bonds are inherently bad investments. It just means that the type of bonds you hold and the strategy you employ will matter more than ever before. No, bonds are not dead, but the way we approach them must evolve. In the past, bonds were considered a set-it-and-forget-it investment. You could buy a bond, hold it to maturity, and enjoy a steady stream of income. Today, however, investors must be more discerning. Bonds with shorter durations may offer better protection against rising rates, as they will be less sensitive to interest rate changes. Treasury inflation-protected securities are another option to consider as they adjust with inflation. Municipal bonds may provide tax advantages, and high-yield corporate bonds, though riskier, may offer greater returns. But even in these categories, caution is required. As investors, the key takeaway is not to panic. Yes, bonds are facing headwinds. Yes, they may not offer the same safety they once did. But in every challenge lies an opportunity. The challenge is to evolve your approach, understand the risks, and diversify. The opportunity is to find new ways to make bonds work for you, even in a rapidly changing environment. Part of that evolution is maintaining a long-term vision. In investing, patience is crucial. While bonds may not offer the same level of comfort they once did, that doesn't mean they're without value. They still have a place in your portfolio, just as long as you recognize the risks and adjust accordingly. As we approach 2026, the financial world will be a different place. The era of ultra-low interest rates and tame inflation may be behind us. But that doesn't mean your investment strategy should fall into the trap of short-term thinking. Instead, it's time to get back to basics, understanding the fundamentals, diversifying your investments, and thinking long-term. If you can do that, you'll be better prepared to weather whatever the market throws your way. So, as we look to the future, I urge you not to see bonds as the enemy, but as a tool that requires new thinking. Understand their vulnerabilities in the face of rising inflation and interest rates, and adapt. Prepare yourself for a world where safety isn't guaranteed and where constant change is the only certainty. Let your strategy evolve and stay rooted in patience, wisdom, and the long-term vision that will lead you to financial success. We've discussed the basic challenges, rising inflation and increasing interest rates, but now it's time to understand how these forces really play out in real-world scenarios and how they might affect your bond investments in 2026. While rising rates hurt long-term bond prices, they also present an opportunity. Rising interest rates may cause the price of existing bonds to fall, but that doesn't mean all bonds are doomed. For instance, shorter-term bonds may not suffer as much as longer-term bonds when interest rates rise. A bond with a shorter duration is less sensitive to interest rate changes because it will mature sooner, and when the bond matures, you can reinvest that principal in higher-yielding bonds. This brings up a crucial point about bond strategy. Duration matters. The longer the maturity of your bond, the more vulnerable it is to interest rate hikes. For example, if you own a bond with a 10-year maturity, you might face significant losses in the first few years if the Federal Reserve continues to raise rates. On the other hand, if you hold short-term bonds, you'll be able to reinvest more quickly and avoid locking in low yields for extended periods. Another thing to consider is that not all bonds are created equal. Treasury bonds, while historically considered among the safest investments, are not immune to the rising interest rates. In fact, the price of long-term Treasury bonds could decline sharply if rates continue to rise, as investors seek higher yields elsewhere. However, they still have one key advantage. They are backed by the U.S. government, making them relatively safer compared to corporate or municipal bonds. Municipal bonds, on the other hand, might provide a bit more security in certain cases. The interest income from municipal bonds is often tax-exempt, which can be a significant advantage for high net worth individuals who are trying to manage their tax burdens. Additionally, many municipal bonds are backed by local governments that tend to have more stability compared to some corporations. That said, you still have to pay close attention to the fiscal health of the local government issuing the bonds. It's essential to know if they're carrying too much debt, or if they have a strong enough revenue base to avoid defaulting on bond payments. Corporate bonds are a completely different animal. These bonds, issued by corporations, come with higher yields, but they also come with more risk. When corporate bonds offer higher returns, they're compensating investors for the risk of potential default. If you're considering investing in corporate bonds in 2026, it's crucial to assess the creditworthiness of the issuing company. A bond from a well-established corporation with a strong balance sheet might seem safe, but even those companies can face risks in times of economic uncertainty or rising interest rates. Another key factor to consider in today's bond market is inflation-linked bonds like Treasury inflation-protected securities. These bonds are designed to adjust their principal value with inflation, which can provide some protection against rising prices. TIs are becoming increasingly attractive in today's inflationary environment because they allow you to keep pace with rising prices while still generating returns. But types are not foolproof, and they come with their own set of risks. If inflation comes in lower than expected, you might not earn as much as you anticipated. But beyond just the type of bonds you invest in, the broader economic environment plays a huge role in determining the success of your bond strategy. The question we must ask ourselves is, what do we expect the economy to look like in 2026? Will inflation continue to rise? Will interest rates keep climbing? Will we enter a recession, or will economic growth continue to chug along? These are the questions that will shape bond markets, and they're questions no one can answer with certainty. One thing we can be sure of, though, is that the days of low interest rates are likely over. The Federal Reserve has been tightening monetary policy in response to inflation, and while this is necessary to control rising prices, it has a direct impact on bonds. For bond investors, this means that you need to be prepared for volatility and more unpredictability. You may need to adapt your portfolio to reflect these new realities. For instance, if you're holding long-term bonds and are facing potential losses due to rising interest rates, you might want to consider shifting some of your investments into shorter duration bonds or even other asset classes like stocks, real estate, or commodities. Diversification has always been a cornerstone of smart investing, and it's never been more important than in times of uncertainty. The key takeaway from this part is that bonds still have a place in a diversified portfolio, but you must adjust your strategy to the changing environment. It's not enough to blindly buy and hold bonds for the long term and expect to receive the same benefits you did in the past. Understanding the risks and being willing to adjust your approach is essential. Just because bonds aren't as safe as they once were doesn't mean you should abandon them altogether. Bonds still offer relative stability and can serve as a ballast in your portfolio, but they can't be your only strategy, especially in the current market. You must diversify your holdings, remain flexible, and always keep a long-term perspective in mind. This leads to the question, what should an investor do in 2026 to protect themselves from the potential risks of bonds while still benefiting from their stable income? This is where strategic thinking, knowledge of the market, and an ability to adapt come into play. As investors, our task is not just to seek out safe investments, but to seek out investments that provide the best balance of risk and reward. And in 2026, that balance will require a thoughtful approach to bonds and an understanding of the changing economic landscape. Let's now consider how inflation might continue to shape the bond market moving forward. As we continue our exploration of bonds in 2026, it's critical to understand the influence of inflation on the bond market. We've already seen that inflation, when it rises unexpectedly, can hurt bond prices, especially long-term bonds. This is because inflation erodes the purchasing power of the bond's fixed payments, making them less valuable over time. And as inflation increases, central banks like the Federal Reserve are forced to raise interest rates to combat the rising cost of living. But inflation in itself is not necessarily the villain here. In fact, there's a way to view inflation as both a risk and an opportunity for savvy investors. It's how you respond to that inflation that matters most. The question you need to ask is not just how much inflation will rise, but how to position your bond investments to avoid getting burned while taking advantage of the changes in the market. Inflation-linked bonds, or T-PES, can play a crucial role in a rising inflation environment. These bonds are designed to protect against inflation by adjusting the principal value of the bond to reflect the consumer price index, the main measure of inflation in the economy. As inflation rises, so does the value of TIPs, and this provides a natural hedge against inflation's erosive effects on fixed income investments. However, TPs are not without their risks. In times of low inflation or deflation, the adjustments to the bond's principal might not be significant enough to generate positive returns. Moreover, TIPs tend to have lower yields than traditional bonds, which might make them less appealing if you're looking for higher income. But for those concerned about inflation in 2026, they represent a sensible choice, a way to anchor your investments in a world where inflation could remain elevated for some time. The bond market, however, is not just a story of inflation and interest rates. It's also about risk management. The inflationary environment is challenging, but there are ways to mitigate that risk through diversification. It's tempting to think that bonds are a one-size-fits-all solution, but nothing could be further from the truth. Bonds are simply a part of a much larger puzzle. In this environment, investors need to look beyond traditional bonds. It's essential to consider the broader macroeconomic factors at play. For example, consider the possibility that inflation could remain high for several years, or that the economy could enter a stagflationary period where growth stagnates but inflation remains elevated. This would be a difficult environment for most bonds, especially longer duration bonds that are sensitive to rising rates. So what are the alternatives? One avenue to explore is corporate bonds. While they come with additional risk, corporate bonds, especially those issued by companies with strong balance sheets, can offer attractive yields. These bonds may not be as affected by inflation in the same way that government bonds are, particularly if the companies issuing them have pricing power and can pass on higher costs to consumers. In addition, many corporations have relatively low levels of debt, which means they are in a better position to weather economic shocks and rising interest rates. Another area to consider is municipal bonds. While they too can be affected by inflation, they carry the added benefit of being tax advantaged, making them particularly attractive to high-income earners looking to preserve capital. Many municipal bonds are backed by strong local governments, and while defaults do happen, they are less common than defaults from corporations. However, municipal bonds come with their own set of risks, and it's important to assess the fiscal health of the local government before diving in. As you explore alternatives to traditional government bonds, it's important to understand the risks associated with each type of bond. Corporate bonds, for example, come with default risk. While the yields are higher, that higher yield is a direct reflection of the risk you are taking on. Even high-quality corporate bonds carry the risk of default if the company runs into financial trouble. This is why assessing the creditworthiness of the issuer is essential before committing your capital. Inflation is also causing some interesting developments in the world of alternative investments. For example, real estate investment trusts have become an increasingly attractive option for many investors in an inflationary environment. Real estate tends to be a good hedge against inflation because property values and rents generally rise with inflation. As inflation increases, so too can the income generated by real estate assets. However, it's important to be mindful of rising interest rates, which can put pressure on the real estate sector, especially for companies that are highly leveraged. Commodities, including gold, silver, and oil, can also serve as an effective hedge against inflation. While they don't generate regular income like bonds do, commodities can provide a store of value during times of rising inflation. Historically, gold has been viewed as a safe haven during times of economic uncertainty and inflationary pressure. However, commodity investments come with their own volatility and should be approached with caution, especially in a world where global demand can fluctuate rapidly. At the end of the day, inflation and rising interest rates aren't going away anytime soon, and it's essential to reassess how bonds fit into your portfolio. There's no one-size-fits-all solution. Instead, it's about strategically diversifying your holdings and making sure you're invested in bonds that make sense given the environment. The key here is adaptability. As inflation and interest rates evolve, so too must your approach to bonds and fixed income investments. The market will always be subject to change, but if you can position yourself to weather the storm, you'll be much better off in the long run. It's about understanding where the risks lie and making informed decisions that protect your portfolio while still providing the income and stability you need. So, as we move toward 2026, remember this: bonds are still a crucial part of any portfolio, but they need to be approached with a different mindset than in previous years. They're not the safe haven they once were, but with the right strategy, they can still provide value. And if you're willing to diversify, be patient, and keep your long-term vision in mind, you'll be prepared for whatever the future holds. As we continue our deep dive into navigating the world of bonds in 2026, let's shift our focus to the broader context in which these investments will play out. Bonds, while often considered a safe bet, are far from immune to the macroeconomic forces at play, especially when inflation, interest rates, and global instability come into play. Understanding this interplay is key to not just surviving, but thriving in today's volatile market. In times of high inflation, the temptation is often to retreat to what we know, bonds, the stable, steady hand of the investment world. But the question you must ask is this: are bonds truly the safe haven they once were? The answer, as we've discussed, is not so clear-cut. We are now in an era where central banks are tightening monetary policies and raising interest rates to combat inflation. These actions are affecting the bond market in ways we've never seen before. Let's break this down. When interest rates rise, the value of existing bonds falls. This is because newer bonds are issued with higher interest rates, making older bonds with lower rates less attractive. For instance, let's say you buy a 10-year bond at 3% interest. If rates rise to 5% next year, your bond becomes less valuable because investors can buy new bonds offering a higher return. This phenomenon is known as interest rate risk, and it's something you need to be acutely aware of as you navigate this market. So how do we manage this risk? The first step is understanding the bond's duration. Duration is a measure of a bond's sensitivity to changes in interest rates. The longer the duration, the more sensitive the bond is to interest rate hikes. In a rising interest rate environment, shorter duration bonds tend to perform better because they are less impacted by rate hikes. So, if you're invested in long-term bonds, you might want to consider shifting towards short or medium duration bonds. But this isn't just about reducing risk, it's about being strategic. You want to think not just about surviving the storm, but positioning yourself to thrive during the recovery. In the aftermath of inflation and higher rates, the bond market could look very different. You might see the rise of new opportunities in corporate bonds, municipal bonds, or even international bonds. The key is to be flexible and adaptive, while always keeping a long-term perspective. Now, let's take a moment to consider another aspect of bond investing that many overlook: the power of compounding. Even in a rising inflation environment, bonds can still be a source of steady income, provided you choose wisely. It's easy to get distracted by the headlines about inflation and rate hikes, but don't lose sight of the fundamental power of compounding. Reinvesting the interest you earn from bonds can help you weather short-term volatility and build wealth over time. In fact, compounding is one of the most powerful forces in investing. It's the principle that your interest or earnings earn interest on themselves. So, while inflation may erode the purchasing power of money, the reinvestment of bond interest can help you preserve and even grow your capital in real terms. It's about thinking long-term and trusting that over time, your steady investments will accumulate into something substantial. But let's be real. Investing in bonds in 2026 is not without its challenges. We are operating in a world where traditional models of investing are being tested. Rising inflation, global uncertainties, and market volatility are creating conditions that require a new level of awareness and flexibility. But this is exactly why it's so important to develop a deep understanding of your investment strategy and the underlying forces at play. One of the most important aspects of bond investing in 2026 is understanding the impact of geopolitical risks. We live in a world where global events can impact the bond market in profound ways. Political instability, trade wars, and shifting economic alliances can all influence bond prices and yields. As an investor, you need to stay informed about these developments and be prepared to adjust your portfolio in response. Moreover, one of the most compelling opportunities that exists in the current bond market is the potential for global diversification. While U.S. bonds are certainly a staple in many portfolios, global bonds present an intriguing option. Some countries may experience lower inflation rates or may be less impacted by rising interest rates. Global diversification can provide stability in times of domestic volatility and offer access to higher yielding bonds in other countries. Another aspect that needs to be factored into your decision-making process is the credit risk of the bonds you invest in. As inflation rises, businesses face higher costs, and governments may be forced to issue more debt to finance their operations. This could lead to credit downgrades, which in turn could affect the value of the bonds they issue. This is particularly important for corporate bonds, where the financial health of the issuer plays a critical role in determining the bond's safety and return. It's essential to assess not only the bond's yield, but also its issuer's creditworthiness. When inflation rises and economic conditions become more challenging, even bonds from seemingly strong companies can become riskier. That's why it's critical to evaluate a company's financial health before committing your capital. You need to ask yourself, can this company weather a storm of rising interest rates and inflation? Does it have the resources to meet its debt obligations even in a tough environment? Another key factor to consider is inflation-linked bonds like T-piece. These bonds are designed to protect against inflation by adjusting the principal of the bond based on changes in the consumer price index. As inflation rises, the value of T-piece increases, making them a natural hedge against inflation. However, it's important to understand that T-piece don't come without their trade-offs. They typically offer lower yields than traditional bonds, and in times of low inflation or deflation, they may not outperform other types of bonds. T-piece, however, are an essential tool for those who are concerned about inflation eroding the value of their investments over time. They provide a built-in protection mechanism that allows your bond's value to grow with inflation, ensuring that you don't lose purchasing power over the long term. The key here is balancing the potential benefits of types with their lower yields, especially in a rising interest rate environment. As we move forward, it's important to emphasize that investing in bonds in 2026 requires a more sophisticated approach. The old rules of bond investing are no longer enough. In a world of rising inflation, higher interest rates, and global uncertainties, you need to take a more nuanced approach to building your bond portfolio. Diversification, flexibility, and a long-term view are more important than ever. The reality is that bonds, as we once knew them, have changed. They are no longer the unshakable pillars of safety they once were. But this doesn't mean bonds have lost their place in your portfolio. It means that more than ever, you need to adapt, diversify, and stay vigilant. You need to assess the broader market conditions, the interest rate environment, and the geopolitical landscape when making your decisions. In conclusion, bonds in 2026 are not as simple as they once seemed, but with the right strategy, a strong understanding of the market forces at play, and a long-term perspective, you can still make bonds work for you. Remember, the road to successful investing is never linear. It's full of twists and turns. But if you're willing to adapt and evolve with the changing times, your bond investments can continue to generate steady income and stability for years to come. Now, as we approach the final part of our discussion on bonds, let's take a step back and reflect on the core principles of investing. At the heart of every successful investment strategy lies a deep understanding of the market forces that shape the landscape. When we think about bonds, we often think of them as a safe bet, a steady stream of income that will weather the storm of market volatility. But in today's world, that safety is no longer guaranteed. The shifting tides of inflation, interest rates, and global uncertainty demand that we rethink how we approach bonds in our portfolios. The truth is, bonds in 2026 aren't the same as they were in years past. The traditional view of bonds as a low-risk, stable investment has been upended by rising inflation, changing interest rates, and the complexities of a globalized economy. So how do we navigate this new landscape? How do we continue to use bonds effectively while adapting to the changing environment? The first thing to remember is that bonds, like any investment, require careful evaluation. In the past, many investors simply relied on the stability of government bonds or the perceived safety of II-rated corporate bonds. But today, we must look beyond the surface and examine the broader economic conditions that affect bond performance. Inflation is a key factor in this equation. As inflation rises, the purchasing power of the bond's fixed interest payments erodes. If inflation outpaces the return on your bonds, you're effectively losing money in real terms. So, how do we combat this? One answer lies in adjusting your bond strategy to include inflation-protected securities like T-piece. Treasury inflation. Protected securities are designed to protect your investment against inflation by adjusting the principal value of the bond based on changes in the consumer price index. Ties provide a natural hedge against inflation, ensuring that the value of your bonds rises with inflation, preserving your purchasing power. However, as I mentioned earlier, these bonds typically offer lower yields compared to traditional bonds, and they may not perform as well in a low inflation environment. Therefore, the key to using T-piece effectively is to balance their benefits with the overall performance of your portfolio. In times of high inflation, T-piece can be a valuable addition, but they shouldn't be your entire strategy. Another consideration when investing in bonds during periods of high inflation is the role of interest rates. As central banks raise rates to combat inflation, bond prices typically fall. This is a critical point to understand. When rates go up, the value of existing bonds goes down. This is why many bond investors are now shifting towards shorter duration bonds, which are less sensitive to interest rate hikes. Short duration bonds tend to perform better in a rising interest rate environment because they mature more quickly, allowing investors to reinvest the proceeds at higher rates. If you're holding long-term bonds, you may be exposed to greater price volatility as interest rates rise, making short duration bonds a safer choice in the current climate. Short duration bonds may not offer the highest yields, but they offer a safer alternative in a market characterized by rising rates and inflation. But even in a world of rising interest rates, bonds can still play an important role in your portfolio if you're strategic. The key is diversification. While you may want to avoid locking yourself into long-term bonds with low yields, you can still benefit from a well-diversified bond portfolio that includes a mix of short, medium, and long-duration bonds, as well as bonds from different sectors and regions. Diversification helps to spread risk and can help you weather the ups and downs of the bond market. But remember, diversification alone isn't enough. You must also stay informed and be prepared to adjust your portfolio as the economic landscape changes. This means monitoring interest rates, inflation, and the broader market conditions that impact bond prices. It means constantly evaluating the creditworthiness of the issuers you're investing in and making sure your bond investments align with your overall financial goals. In addition to diversification, it's important to consider the role of international bonds in your portfolio. The bond market is global, and opportunities exist outside of your domestic market. By investing in international bonds, you can gain exposure to countries with different inflation and interest rate environments, potentially increasing the stability and returns of your bond portfolio. However, international bonds also come with their own set of risks, including currency risk and geopolitical risk. The key is to balance these risks with the potential rewards. By including a mix of domestic and international bonds, you can achieve greater diversification and reduce your exposure to any one country's economic conditions. One thing that often gets overlooked in discussions of bond investing is the importance of credit quality. In times of inflation, credit risk becomes even more significant. Companies and governments that issue bonds may struggle to meet their debt obligations if inflation erodes their revenue, or if their creditworthiness is downgraded. As an investor, you need to pay close attention to the credit ratings of the bonds you hold. Bonds from lower-rated issuers may offer higher yields, but they also come with higher risk. In times of economic uncertainty, this risk can become much more pronounced. So how can you protect yourself from credit risk? The answer lies in thorough research. It's crucial to evaluate the financial health of the companies and governments behind the bonds you invest in. Look at their debt levels, cash flow, and overall financial stability. The stronger the issuer's financial position, the less likely they are to default on their bonds. Even in challenging economic times, it's also important to remember that bond investing is not a one-size-fits-all strategy. What works for one investor may not work for another. Your age, risk tolerance, financial goals, and investment horizon all play a role in shaping your bond strategy. In the current environment, some investors may choose to take a more conservative approach by investing in high-quality bonds with shorter durations, while others may choose to take on more risk by investing in longer-duration bonds or bonds from higher-yielding issuers. Ultimately, the goal is to create a bond portfolio that aligns with your overall investment strategy and financial objectives. Bonds can provide stability, income, and diversification in your portfolio, but they are not without risks, especially in an inflationary environment. By staying informed, diversifying, and being strategic about your bond investments, you can still make bonds work for you, even in these challenging times. In conclusion, bonds in 2026 are not the same as they once were. Rising inflation, increasing interest rates, and global uncertainty have all contributed to a shift in the bond market. But that doesn't mean bonds are no longer a viable investment. It means that more than ever, you need to be strategic, adaptable, and well-informed. Remember, the key to successful investing, whether in bonds or any other asset class, is to stay focused on your long-term goals, stay disciplined, and stay flexible. The road ahead may be bumpy, but with the right strategy, you can navigate the challenges and build a portfolio that will serve you well for years to come. So, as we wrap up our discussion on bonds and inflation, I leave you with this thought: in times of uncertainty, the greatest investment you can make is in your own knowledge. The more you understand about the forces shaping the market, the better equipped you'll be to make sound investment decisions. The bond market, like all markets, is ever changing, but with the right mindset, you can turn today's challenges into tomorrow's opportunities.